let's work on the periodic inventory system. We're going to use the information that was provided in problem 6-8A, which is your homework assignment, but you had done that using the perpetual inventory system. In the periodic inventory system, we periodically update cost of goods sold and inventory records. We don't do that each time there is a purchase or a sales transaction. So let's bring the information over from the previous problem. We began the month of January with 160 units that came from last period at $20 a piece. The extension is 3,200. We made 3 purchase transactions. A total of 275 units were purchased at a cost of $650. Sorry, $6,500. What we have available for sale is the beginning balance, the inventory we had on hand, plus the purchases for the current period. That gave me this cost of goods available for sale. Put that in different color over here. And the extension over here is 160 times 20, and the 275 was these 3 numbers added. Similarly, 6,500 is the 3 extensions added. So what I have available for sale is 485 units. That cost me $9,700. This is what's available for sale. Now, if I were lucky at the end of January, all 435 units would be sold. All of this amount would be expensed. Highly unlikely that's going to happen. So of the 435 units, we sold a total of 360 units. So what remains with me is 75 units. How much of this $9,700 should be assigned to the ending balance, 75 units, and how much should be allocated to cost of goods sold expense? We'll take a look at that over here. So in the periodic inventory system, at the end of the period, we will first identify how many units we have on hand, and the number is 75, and it's the same that we had over here, ending units of 75. So regardless of which method we use over here, we have 75 units available on hand at the end of the period. What's the cost per unit? If it's last in, first out, whatever came in last is what was sold first. So what's remaining with me is what was there at the beginning of the period. The cost is $20 per unit. So the extension is 1,500. First in, first out, whatever came in first was sold first. So what's remaining with me is the very last inventory. And that would be $25 per piece. So the extension works out to $1,875. For the average cost method, I take the total units available for sale. I take the extension of the total units available for sale, divide that by the units available for sale, and I come up with an average cost of $22 and $22.299 is the cost per unit, the average cost. So this number, I'm going to go back to highlighting it in the same color as over here to indicate that's where I got that number from. So this is what's going to be assigned to the ending inventory. Again, remember what I told you. Cost of goods available for sale will be assigned to cost of goods sold expense and ending balance. I know what's being assigned to ending inventory. So the difference is what's going to be assigned to cost of goods sold. The sales number is the same for all methods, 15,680. So if you want to look over here in the previous case, we had looked at the 3 sales that took place, the units sold, the selling price per unit, and came up with 15,690. That's the same number I got over here. Cost of goods sold for each of these methods is $9,700 minus what is assigned to ending inventory. So 9,700 minus 1,500 gives me 8,200. 9,700 minus 1,875 gives me 7,825. and 9,700 minus 1,672 will give me 8,028. Gross profit is the difference between sales and cost of goods sold. So I calculate my gross profit for each of these three methods. Let's take a look at the journal entries that we would have in the periodic system. The journal entry for the purchase, there's going to be one difference, and I'll tell you what the difference in a second. We paid 2,200. That's not going to change. Cash credit 2,200. In the periodic method, in the perpetual method, we had debited inventory account. Here we do not debit inventory account. We will debit a temporary account called purchases. So each time there's a purchase, we debit a purchase account. When we have a sale, the journal entry, the first journal entry is identical to the previous, the perpetual inventory system. We had cash debit, sales credit, stays the same over here. We do not do the second journal entry, cost of goods sold debit, inventory credit, because we are not going to update the inventory account each time there is a sale or a purchase. So when do we do that? We do it periodically, and in this case, it's going to be at the end of the period, which is end of January. So what are we going to do over here? If you recall, I told you this was a temporary account, the purchase account. I need to close that down. The inventory that I had at the beginning of the period, I need to close that down and establish a new inventory account. And I also will establish my cost of goods sold expense. So let's start with how I'm going to, I know cost of goods sold has to be debited. So I'm going to debit cost of goods sold. Purchases was debited. To close it, I'm going to credit it. I'm going to close the beginning inventory. Inventory is an asset with a normal debit balance, so I'll close that account. And I'll open a new inventory account that establishes the ending balance. So what I need to do is, I need to add up all the purchases. I had 3 purchases, adding up to 6,500. So all of that gets closed down, 6,500. My inventory beginning balance was 3,200. I close that down. My inventory ending balance, I had established that to be 1,500. And then I said, cost of goods sold would be 9,700 minus 1,500, 8,200, and I put that over here. So what you will see over here is goods available for sale, which is basically this 3,200 and 6,500. This is what was available for sale, will be distributed to ending inventory and cost of goods sold expense. So total debits, which is 9,700, must equal to total credits, which is 9,700. So your journal entries, as the transactions are taking place during the month, will be the same in the FIFO, LIFO, weighted average method in the periodic system. Where we have a difference is in this last journal entry. And the difference really is in the amounts that you assign to these two accounts. Purchases is basically what it was. Inventory is, beginning balance is what it was. So it's these two numbers that you assign that's going to be different in the periodic inventory system. So in a lot of ways, the periodic inventory system is a lot easier to do as a student. But as a business person, this doesn't give me any information about the inventory that I have left on hand, what the pattern of my sales were, etc. All of which I can see in the perpetual inventory system. As I mentioned before, the periodic system was used extensively almost by everyone across the world until about 10 years ago. Now even the largest business uses the perpetual inventory system everywhere across the world, and that's largely because computers have become so affordable and user-friendly. Both those factors are in play. At some point of time when computers were expensive, large companies could afford them, but they weren't user-friendly. Now the softwares have become so user-friendly that almost no one uses a periodic inventory system. The The perpetual inventory system is the richer system in terms of information for decision making. So in your chapter 6, both these methods are covered, both the systems are covered. You need to review both of these systems.